Hello Mark. So this is your first set of results for Aviva. What are your impressions?
Well, hello Simon. It's been an interesting couple of months in the job. In that time I've seen shareholders, I've seen regulators, my diary's been full of staff and customers, and I've even spent time on the phones listening to our call centre people. I think I understand the issues very clearly what the business is going through. We have insurance in our DNA after 300 years. And the core underlying insurance businesses have performed well on the whole. That really comes through. But you know what? Over a number of years we have disappointed and even angered some of our shareholders. Our investment performance as a stock has lagged some peers. John McFarlane and the board in July last year took a fresh look at the company. They looked at the company through a different set of eyes and they realised the issues that had to be addressed. They came up with a plan that was right. That plan meant that we disposed of some of the large businesses. And you can see a bit of the noise in our numbers this year from those disposals they made. But it was the right plan, and really you can see that coming through in the results.
So Mark, give us your perspective on the results. Give us some detail.
Well Simon, these results are dominated by the 3 billion sterling loss. And that can mainly be attributed to the 3.3 billion sterling write-down on the sale of the US business. Now that's been well signalled to the market, and so that shouldn't be a surprise to anyone. Under that, the underlying businesses perform very well. And of course, a bit more noise in those numbers as we have quite a few restructuring costs that were put into the year as well. Now the focus of last year was on generating capital. It was on strengthening our balance sheet. That was the plan put in by the board, and that has been achieved very well indeed. In fact, if you have a look at our economic capital surplus, that's gone from about 130% to over 170%. That's doubling our surplus. That's an important measure for an insurance company.
So Mark, you've talked about the importance of a strong balance sheet, but what does that mean to you?
I think it means two things. A robust balance sheet means you have to have a robust capital position, and I think we've achieved a lot of that. We're now well into our target range. And also you must have an acceptable level of leverage or debt. And when it comes to debt, we have two aspects to it, internal and external. The board and John McFarlane made it very clear last year that debt was an issue to the group and had to be addressed. Now is the time to address that issue. And so we have clear plans in place. On the internal leverage, we will pay down £600 million over the next 3 years. On the external leverage, we would like to get down to under 40% leverage ratio or debt ratio. And these are both achievable targets.
I'd like to ask about your investment thesis. What is your thinking on that?
When I was talking to investors, one thing came across very clearly. They all asked the same question. Why hold the stock or why buy the stock? Now, I call this our investment thesis. What's the central reason of why Aviva? Well, I think there's a compelling answer to that. It's about cash flow and growth in that order. Aviva's a big business. It has a huge in-force book of 28 billion sterling. It has over 300 billion in terms of funds under management, and that can be a huge cash flow generating machine if we do it right. So our thesis is about cash flow plus growth in that order.
This all sounds very interesting. Obviously people will be keen to know how you're going to achieve this.
To buy into our investor thesis of cash flow plus growth, you need to believe a few things. One, that we have a robust balance sheet with the acceptable level of leverage. Two, that we can execute our plans, especially on these turnaround amber sales. Three, that we can generate the cash flows out of our book and out of our back book to get progressive dividends going forward. You have to believe these things to believe the investor thesis. So to do that, we're going to focus our large businesses on cash flow generation above all else. That's managing the back books, that's getting the right products with the right profit signatures, that's managing expenses very closely indeed. That's all achievable. On some other countries like perhaps Turkey and Poland and Asia, it's more about growth, and they'll be measured by value of new business primarily, but not at the expense of cash flow and not at the expense of capital.
Now, Mark, historically, some have questioned whether Aviva should be a composite insurer. What's your take on that?
Simon, if the question is, should we be a composite, then it's the wrong question. The fundamental principle of insurance is about diversity. It's about taking the risk from one person and spreading it over many. That's diversity. It's about cash flows and diversity. Aviva has scale in life insurance, in general insurance, and in funds management. They are three strong core businesses to the group. In any one market, we may be in one of those business lines, two or three. Now, the interesting thing is when you have more than one business line, it should give you more consistency of earnings because the earnings flows from those three business lines aren't correlated. Also, there's substantial capital benefits through being a diversified insurance group. Those benefits allow us to reduce our capital substantially because we can diversify risk. That's a good thing. It's a good thing from an investment perspective. The question is, can we manage complexity? And I think the moves that the group has taken over the past 12 months to simplify the group, to have fewer countries to focus on, reduces that complexity substantially. We need to continue along that journey and we're not there yet. So one of our focuses will be significantly simplify the group but have diversity of earnings from those three core business lines. It's pretty fundamental.
Now, Mark, you are reducing the dividend. What is the background to that?
Leading up to the announcement, there was definitely two schools of thought. On one hand, you had analysts who said, you know what, Aviva's got enough liquidity from the sales and disposals to keep the dividend at that level. On the other hand, you had analysts who were saying, fundamentally, the underlying businesses haven't been earning enough to keep that same level of dividend. Both of these arguments are right. The question that the board and I had to address was about our overall balance sheet and the leverage position, both internal and external. To believe our investment thesis, I said before that you have to believe that we have a robust balance sheet with clear plans in place to reduce leverage. We had to fix this question once and for all, and that's what we have done.
I'm sure you've anticipated, of course, that some investors won't be comfortable with this. How do you think they'll react?
I think some investors will certainly be disappointed. I would also hope that would be mitigated to an extent by the fact we have eliminated the scrip option. Now, the scrip is dilutive and a bad thing for shareholders, and it is also not consistent with our cash flow thesis. The scrip, in fact, has been dilutive by about 16% over the past 8 years, and that's a lot. What we want is a clean, simple investment story of cash flow and growth. By rebasing the dividend, by paying down internal and external debt, and by eliminating the scrip, I think that's a very positive story to go forward and puts Aviva on a very sound footing.
Looking forward, what are your priorities for 2013?
I think they can be summed up in three things: cash flow, simplicity, balance sheet strength. On the cash flow, we need to focus the businesses on getting that cash flow out. That's part of our investment thesis. On the simplicity, we need to simplify the business further. One of the key things we need to do is develop our customer thesis, a simple proposition that customers know they can expect from Aviva. That's going to take a number of months' work this year. The balance sheet strength is about reducing the debt and continuing the good work that's been done over the past 12 months. Now, it's important not to forget that our fundamental underlying businesses are first class. Our insurance expertise really is right up there. And it's the businesses that are going to generate the cash flows, they're going to keep our customers happy, and ultimately are going to get the returns for the shareholders. We have a strong business, we have a strong team. The announcements made put us on the right footing for the future.
Mark, thank you very much for your time.
Simon, thank you.